or amendments in income tax law relevant for tax audit financial year 2019-20. We have our speaker, our own member, Veeramani sir. May I request our chairman, CA Roy Varghese, to welcome the speaker and all the participants here.
Good afternoon to you, respected seniors, colleagues and friends in profession. Welcome to webinar on changes or amendments in income tax law relevant for tax audit 2019-20, organized by ICAI Ernakulam branch. Respected seniors and colleagues, we are all gearing up for tax audits and filing of IT returns. There are big constraints for all of us due to the prevailing COVID-19 pandemic. The functioning of our offices may not be in full stream. Partially working from office and remote working has become a new normal for many of us. In the last finance bill as well, through subsequent notifications and changes brought in by Finance Ministry, there are many changes or amendments relating to tax audit for the 2019. It is important that we are familiar with those changes and amendments while carrying out our audit responsibility. Today, our learned resource person will guide us through those related changes and amendments and refresh and update our knowledge, enabling us to conduct our audit work in a more meaningful manner. Friends, yesterday I had the opportunity to interact with the Principal Commissioner of Income Tax, Sri Ravindra Kumar sir, at his office at Kochi. Our resource person was also there on that occasion. The representatives of Chamber of Commerce and Industries were also there. In the discussions, the Principal Commissioner was referring to the prevailing COVID-19 pandemic situations and how it affected our economy. He also referred to the concessions and support given by the IT department to the assessees during this period and was worried about the reduced revenue collections for the government. In the meeting, the Principal Commissioner requested us to submit our suggestions or recommendations for specific support or corrections, if any, the assessees as a whole or class of industries or business need to withstand or recover from the damage brought in by the pandemic and to revive the economy, thereby augmenting the revenue collection. It is not our individual single assessees or single business problems which we need to highlight. The assessees as a whole or the industries as a separate class, what better option we can do or which the government can support to revive them or to bring them back to the economy and to make the economy more vibrant. That is what we need to suggest. I request the members to submit your suggestions in this regard through mail to ICAI Ernakulam branch so that we can submit a consolidated suggestion or recommendation before the Honorable Principal Commissioner for submission to the government for their consideration. Again today, being the representative of Ernakulam branch of ICAI, I was invited to attend a video conference program of Honorable Prime Minister of India, who launched the platform Transparent Taxation Honoring the Honest. It was a historic occasion wherein faceless assessments, faceless appeal and tax-based charter were launched for the entire country. Hereafter, there won't be any need to interact with any IT authority for assessments or appeal. We will not know who will be conducting our assessment or appeal of our assessments. There won't be any need for us to go to the IT office for any assessments or appeal purposes. And it mandates that the taxpayer should be honest and compliant, inform, respond in time, pay in time, and moreover, to know what the authorized representative does on their behalf. I feel that this is going to change the way we practice our profession also. Hence, the learned resource person today is none other than CA P.M.Veeramani sir, who is well known to many of you attending this seminar. He is an authority on income tax laws. We are really happy to have him here today and believe that the session by him will enlighten us and update our knowledge and enable us all to undertake our tax audit work more efficiently. On behalf of Ernakulam branch of ICAI, I extend a hearty welcome to CA Veeramani sir, the resource person today to this webinar. Welcome sir, please. Let me also welcome all the colleagues and seniors and friends in profession and the MC members present here today. Secretary K.V. Jos, Vice Chairman C.A. Ranjit, and all others to this webinar. Wish you all have a wonderful learning time. And before proceeding further, two brief points. If any member wants to raise a question, he can raise it in the Q&A box. Q&A box is beside the chat box within a 3-dot mark or question mark on it. Don't mix your general comments with the questions. All the general comments can be posted in the chat box and questions in the Q&A box. If the member wishes to raise the question directly to the resource person, please express it in Q&A box and you will be called to raise the question in person at the appropriate time. Again, on CPE credit entitlement. CPE directive has made it mandatory that each member should register and attend the session. The registration report and the attendance report generated from the web platform is a proof of members attending the webinar, and the CPE credit is allotted on the basis of the attendance report, not on the basis of the registration report. Please ensure to register in advance and log in early and attend the session. Remember, simple registration alone without attendance will not make you eligible for CPE credit. Also, please ensure you register early. Due to technical reasons, registration time for non-IRS members has been given till 12 midnight of the previous after webinar. The AR members have time for registration till 1 hour before the scheduled webinar time. Please note that your login time and duration of attendance in this session will be very clearly stated in the attendance report generated from the web platform. There were instances of members trying to log in after 1 hour of the moment of the after 1 hour of the commencement of the session and even at the last minute of the webinar session. The CPA Directorate is strongly objecting to such late entrance practices, and hence we are compelled to restrict admission to webinar after 1 hour of commencement of the session. Please note this. It is brought to your information that admission to the webinar will be restricted after 1 hour of commencement of the session. Kindly cooperate with us. Once again, wish you all have a wonderful learning time here today. Thank you for your patient listening. Stay safe and healthy. Thank you. Over to CA Jos for the further proceedings, please.
Thank you, Chairman Sri Roy Varghese. May I request our Vice Chairman, Sri Rijit Warrior, to introduce our speaker, Veeramani sir.
Thank you, Secretary. On a lighter note, I was asking Secretary Veeramani sir ne nammada participants introduce cheyanda avashyam undo. But nonetheless, like how Chairman rightly feels, we have a lot of participants who have registered from outside Ernakulam and outside Kerala. For others who is listening to him probably for the first time or so, P.M.Veeramani sir is a partner to the firm RG & Price and Co Chartered Accountants. He is a regular paper presenter at ICAI, ICSI and ICWI. He is a trainer, a renowned trainer with all the tax departments, banks and the RBI. You might have probably not missed his column, judicial decisions, recent judicial decisions since 2005 at the Ernakulam branch newsletter. He is also a regular writer to the Journal of Society of Auditors, Chennai. He is a very active member at the Cochin Chamber, and he is the chairman of Taxation and Finance Committee of the Cochin Chamber. He is currently the treasurer of Kerala Fine Arts Society, which is a 60-year-old organization. He is also one of those founding members of one of the oldest cricket clubs in Ernakulam or in Kerala, Ernakulam Cricket Club. With these few very little words, let me take this opportunity to invite and welcome Veeramani sir to the session.
Over to you, sir.
Good afternoon to all of you. I think, are you able to see me? I think you are able to see me.
Yes, sir.
Good afternoon, Chairman. Good afternoon, Secretary, and the other office bearers, Ranjit, and a lot of my dear friends. Now, it is almost 5 months into the new normal, or what they call it as lockdown COVID normal. And I was just recollecting the memory with our chairman Roy Verghese when we did the first webinar on 16th or 17th of April, where we had a lot of technology doubts how we could be going about doing it. From there, I think now the branch has become a master, so that we are now more or less got used to the new system. Inherent difficulties, the webinars have to be restricted to 2 to 3 hours. So naturally, the longer duration programs, I think, will be only a history for some time. And we may have to, maybe even if it's a large topic, like a tax audit, we may have to probably break it up into various sessions and then carry out the webinars. As rightly mentioned by the chairman, yesterday I was also present in the meeting with the Chief Commissioner of Income Tax. The message was very loud and clear. The government is finding it difficult to collect revenues. With the service sector totally out of action, goods and services tax have not made any appreciable progress. And because of the COVID situation, the disinvestment program is also not going according to the government plans. So the only source of revenue which the government expects is from the income tax. And they are also very clear that for the current year, advance tax collections also would not be very encouraging, because many of them have not paid the first installment and may not be paying the second installment also. They are expecting, it came out of his own words saying that that they are expecting the advance tax collections to come in only between January and March. Having said that, then there is the only other option available for the government to collect some revenue would be the self-assessment tax for the year ended 31st March 2020. So the message was very loud and clear, and it was also the message was clear that you need not expect any further relaxations or further change in the return filing dates, or even in the due dates for filing returns or audit reports, etc. At best, it just came out of his mouth, at best it can go by 1 month up to 31st of December, because the government would like to collect the revenues. It was also said that because of the Vivek, even though many applications have been filed under the Vivad scheme, the department has not processed it, because once the processed and it is processed and notice is given, tax has to be paid within 15 days, which the SSC may not be able to pay. So hence that has also been put on hold. The chairman was also mentioning about the launching of the new faceless assessments and the jurisdictionless assessments. While that is a welcome measure, but what was a little disturbing was the circular which came about 15 minutes before, which said that under section 119, the government has said both the survey and the search operations will henceforth be done by the investigation wing. Now, how far-reaching it is, only time will tell, because the investigation department works in a particular manner, and the survey by the assessing officer works in a different manner altogether. Whether these can be done by the same persons is something which we need to wait and see. But then we are always looking at changes, because changes are the order of the day. Coming to webinars today, I think our chairman has to be complimented that he has been able to get very many faculties from various parts of the country, whom otherwise may or may not have made a visit to Cochin. It was due to various circumstances. So today it is, I have also been able to participate in many of them because you need not plan early. You can even decide 5 minutes before. Of course, subject to the registration, 5 minutes before, you can always log in. The last part of it, which the chairman said, I have a small suggestion. Even though people may be logging in a little late, you can possibly represent to the CPE. Maybe then you need not give the credit for the attendance, but at least if somebody wants to attend even at the later part of the hour, I don't think it is fair on our part to deny any member to participate or attend any program, because the idea is everyone would like to see, like to hear every speaker. I think that you should take it up. Okay, because giving granting of CPE is prerogative. I don't want to make a comment on that. But to say that after 1 hour you would deny may not be a right proposition. Now, having said that, the number of programs if we are conducting, number of webinars have also been substantially higher when we compare to the physical meetings we have, and given under that circumstances, my being given a second opportunity in about 4 to 5 months, I think I should feel privileged and I should be happy and thankful to this team of office bearers of the Ernakulam branch. Now, let me make it very clear. When we were discussing on this topic, we were very clear with the chairman that this program or this webinar is not on a clause-by-clause analysis of the tax audit, which may possibly come on a later date or which may come in a staggered manner, because as I said earlier, it may not be able to conduct the program 6 to 7 hours together. So this would be a totally different idea altogether. And there were a lot of apprehensions as to whether, since the due date of return is only on 31st of November, he said too premature to have this program done at this point of time. Now, again, when I discussed with the chairman, we found that there are very many reasons why this has to be done at this point of time, which would justify the reasons why we are having this program done at this point. Or I'll straight away go into the slides, and I hope you are able to see that. To see the slide?
Okay.
Shall I go ahead?
Yes, proceed.
Yeah. See, basically, the what we are trying to do today is that the coverage. What we are trying to do. I think this is fine. The coverage today in our program today is on these 3-4 areas. One is the revised due dates based on for the compliance as per notification dated 24/6/2020. As we all know, it was in the last week of March, I think on 27th of March or so, an ordinance was issued in the light of the pandemic, extending various due dates of both filing of various returns and also the audit, etc., which was again changed by the another notification dated 24/6/2020, and that more or less remains standard today. So in the light of this, there are certain compliance requirements which are coming out of this revised due dates, which makes it all the more necessary for us to carry out the audits or even the finalization of the returns at an early date. We will look into that in detail. Then, as usual, every year Finance Act keeps us busy. This year, 2019, and what happens is, by the time we start the audit, we would have had the second Finance Act coming in. Just like this year, now we will all be discussing. We are all more conversant with Finance Act 2020, whereas what we are now required to apply for the tax audit for this year is a changes by Finance Act 2019. And as I was preparing for this program, I found that some of these changes even I had also forgotten, because it is more than 1 year old. We had read this and forgotten. Along with the amendment to the Act, today we have active number of notifications, circulars, or rules being also amended. I think you would recall that Ernakulam branch was the only branch which conducted a program exclusively on the notification, circulars, and amendments to the rules. It was some 2-3 years before, which I had handled, which had a overwhelming response, because many a times we tend to overlook the notifications and circulars. So those notifications, circulars, and the amendments to the rules which are required to be looked into for the carrying out the tax audit for the current year also, we will be looking. And as we all know that when we are carrying out the tax audit, many of the clauses in the Form 3CD are being filled up, relying on various important various case laws decided either by the tribunal or by the High Court or even by the Supreme Court. And the guidance, the institute guidance notes have been harping on this or more than once, saying that wherever we are relying on a particular case law, it is required for us to explain that the reasoning why we are arriving at a certain conclusions or an opinion in the audit. So we would be looking at some of these case laws which have come in during this 2019-20 or maybe even up to about last month or so. So that, which have a bearing on the tax audit report. There are several case laws which have come, but we will be looking into those cases which are definitely which have an impact on the tax audit. And any of these case laws which I will be referring to will always be available in the branch journal, which of course you can log into at Cochin ICAI at org. All the back journals are also available there, so it is easy for you to go back and find out the citation if at all you miss out on any of this. And lastly, I always believe in going back to the institute publications, and I found that surprisingly there was an FAQ on e-filing of tax audit reports, which is a little older one. I think it is 2014 or 15. But I found some of these FAQs are relevant even today. So we will conclude by looking at some of these FAQs, how we should be going about doing the tax audit or as well as filing of this tax audit. So this is the idea. Even though we have said changes and amendments relating to tax audit, this is how we will be going about going about the presentation today. And as the chairman has suggested, I think we will have the question and answer session in the end, because so that I can continue with my presentation and maybe I'll take an hour or hour and a half and try to complete that, and then we will get into the question and answer session. Now let us look at the revised due date of notification. You find that on the one side, if you look at the middle column, which says the revised due date of filing return. One side, you may be happy that all the due dates have been extended to 30/11/2020, but at the same time, it is also a big burden that if all these types of audit returns and the audit reports and these things have to be filed on a particular day, and given the trend that our people come to us only towards the end of the period or towards the last dates, the pressure definitely building on us itself. So it is necessary for us that even though the dates have been, the staggered dates have been changed to 30/11, we need to be following up on many of the cases and trying to complete at the audit at an early date. Mainly because of the third column, if you see, there is even though the due dates have been delayed, there is a liability towards interest under Section 234A if the self-assessment tax exceeds 1 lakh of rupees. And the interest will run from the original due date. So if it is an individual and if he has got a tax liability of more than 1 lakh, then he will be liable to interest from 31/7/2020, even though his due date of filing the return may be 30/11/2020. And how will you ever find out whether there is a balance tax due of more than 1 lakh unless you are able to complete the return of income? And if you want to complete the return of income, it is obvious that we should complete the tax audit also, because today, even if many of the companies, listed companies or who are following Ind AS, you would find that the complete revamping of the statements are required before we can finally come to the figures which are required to be done for the income tax, along with the application of ICDS, which we are all familiar. The other change that has happened this year is that the last row which I have highlighted is that for the first time we are supposed to upload or complete the audit report 1 month prior to the filing of the return of income. Or in other words, if I remember correctly, what the government has said or what the finance minister has said is, based on the tax audit report, the e-filing department or the government will be intimating the assessees what are all the points that need to be considered while filing of the return of income, so that the return comes to be correctly filed without any errors. Or in other words, the tax audit report becomes the crucial document for filing of the return. Unlike olden days when we used to give a tax audit report, the olden days when the physical report which you used to be part of the document returns file, but the assessing officer would proceed on his own manner. Now, with this faceless or the seamless assessments, this document becomes very, very important. And if we have to finalize the tax audit report on 3110, it invariably means that the return also has to be ready on 3110. So this is one of the main reasons why we felt that, it is necessary that we should have a session much earlier, because we are already in the middle of August. And why we waited for August is the next slide will give you the answer. If you see now the revised due dates, see, for most of the TDS returns, the revised due dates have already expired on 31st of July. And in all these cases, you see, if somebody has not missed out on 31st July, you would find that the interest would run from 36. So somebody, if he doesn't file a return or if he delays further, it will be at a cost only, where the interest definitely will accrue, and without payment of interest, you may not be able to even file a return, and you need not expect any waiver from the department, because they are expecting on collection. So one reason why, if at all you look at it from the audit point of view of updation of 26AS or other documents, you would find that almost all the returns which are to be filed, the due dates have already expired on 31/7. And even though you call TDS returns, in many cases, it would be, we ourselves would be doing it for the purpose of the clients, including certain forms like 24 QB and QC, which are new, where the individuals have to file. Well, QB may be older one, QC would be a newer one, QC and QD would be the newer one, but there also the due dates have expired on 31/7. Now, you would find that except for the statement of financial transactions which are required under 285BA, where there is a long extension up to 31st March 2021 is given, but that may not, even though this time it has been said that whatever is filed in 285BA would also find a place in 26AS, but that would be more in the form of an information only. So naturally, it may not have a bearing on the tax audit, unless you have totally gone wrong or totally gone astray in preparing your returns. So 31st March 2021, this extension may not be of much relevance for us. But if you look at the next column, see savings for capital gains, where the due date fell between 23 and 29/9, where you want to claim the exemption under section 54 to 54GB, like investment in a new house, or investment in capital gain scheme or capital gains, etc., capital gain scheme, etc., you have the time till 39/2020, which may more be in the case of individual assessees. It can also happen in the case of companies where they could be going in for some long-term capital gains exemptions, etc. But that, of course, that is the only one where there is a 39 due date. So as our chairman rightly pointed out, we are now getting accustomed to this remote audit. Remote audit has got its own challenges, in the sense that, we are not used to we are used to the conventional seeing of books ourselves and the vouchers ourselves, and now we are now getting used to the system of seeing it in the screen. And we definitely have to, I'm very sure that bank audits, where we had a lengthy discussion even for the branch audits, etc., where we had very senior members talking to us, right from Amarjit Chopra and other people talking to us as to how we should be going about doing the audit on a remote basis. And there are even PDCAI recommendations or instructions given to us how we can be doing it. And there are 2-3 guidance note also has come, which we may have to follow while carrying out this audits. Now we'll move on to the discussions now. See, possibly one of the simplest area where we could be doing compiling of a return was probably the rate of tax, and the rate of tax, especially for companies where we had a single rate of 30% plus surcharge. Now, if you look at the screen today, you see that has become the most complicated one or most challenging one. You see, there are now 5 rates available for the current year. One, where it is purely based on the turnover, while the others are based on the various conditions which are attached to it. Now, to decide especially if it is 2 of them, you have at least one of them, you have the option whether to go under that particular section, while others are all mandatory. To decide to take the option or not itself is a challenge. And that is where possibly we need to, another reason why we need to have the audit completed at an early date if we have to take a decision or advise the client whether to go for the lower rate or whether to continue with the existing rate. If you see where the total, where you see the first one is based only on the turnover where it exceeds, does not exceed 14 crores. The rate of tax is 25% as it's a normal rate of tax, 30%. Then came the section 115BA for manufacturing companies set up and registered after 1/3/2016, where we have a same rate of 25%, but there are certain other conditions to be satisfied if you want to be going in for the 25%. Then, of course, we have the 115BAA, which was initially brought in as an ordinance in 2019 and later brought into the Act by the Finance Act 2020, which was discussed at length, which is being discussed at length, and which has got an impact even on the company audit itself. When you are finalizing the companies itself, you may have to decide on whether you have to opt for 115BAA. And if you look at, if any one of you had the opportunity to see the direct tax referencer ready reckoner of Vinod Singhania in the referencer part 3, where he has given examples of 115BAA, I was reminded of my final income tax paper, which will give you a mandatory taxation question, which will make you sweat all over the place. I think the examples given there are much similar to that. Then you have the 4th category, which is a manufacturing company set up and registered after 1/10/2019, where you have a still lower rate of 15%, 15% of rate of tax. And if you do not fall under any of the 4, then you have the residuary or the normal rate of 30%. So you can imagine how difficult it is. Even on a rate of tax itself, that challenge is now before the chartered accountants or the auditors, as we advise the clients. Now let us look at each of this now. The first one is relatively very simple, and you would all remember that this started in with the Finance Act 2018, presented by late Finance Minister, late Sri Arun Jaitley, where he said there is a big clamor by the corporates to reduce the rate of tax from 30%, and accordingly the government is bringing down the rates to 25% in that year. And for that, the condition set for that year was that if the turnover for the 2 previous for the financial year 2015-16 was less than 250 crores, then you could opt for the lower rate of 25%. So all you had to see was the turnover 2 years before, audited accounts turnover 2 years before, and if it was less than 250 crores, then you could have opted for the lower rate of 25%. Now 250 crores over a period of time has now gone up to 400 crores. This is what they have revised. And 400 crores, the years have also been advanced. So the 400 crores should be, if the 400 crores or less for the financial year, the 2017-18, then you can go under there is no option. You can definitely go under the lower rate of 25% plus applicable surcharge. Now, the question that would come here is, suppose a company was not in existence in 2017-18, how would you, whether you are eligible to go in for the lower rate? The answer is no. It says it is applicable only for those companies which was in existence and which had a turnover. And this is more or less explained by the new section 115BA, which was introduced. If you see, it was Finance Act 2018 which introduced section 115BA, where they said any manufacturing company set up and registered after 1/3/2016 can go in for the lower rate of 25%, which is the same as the rate based on this turnover base. So that makes it all the more clear that if the company was not in existence prior to 2017-18, then you are not eligible to go for this turnover based rate of lower rate of tax of 25%. Now the big question may arise that, a company which has been set up and registered, and a manufacturing company that too, which has gone up and registered on 1/3/2016, could have had a turnover of more than, could have had a turnover of 400 crores, or for that profit, could it have had a profit to pay 25% is a big question. But government, it's its own wisdom, has brought in. So anybody who is having a profit can go to the lower rate of 25%. This particular rate is fairly simple. You need to look at only at the turnover part of it. Now the more difficult one comes from the next one. So what I have done is, because all the three sections have more or less the same conditions attached, I have made it into a table. So we will just be looking at the 115BA, BAA and BAB. Now, first is the eligibility criteria. You find that 115BA is applicable only for the manufacturing sector, and so is the 115BAB is also for the manufacturing sector, while 115BAA there is no restriction. Anybody, including a service company, can go under 115BAA. Now, what are the other conditions? For 115BA, it has to be set up and incorporated after 1/3/2016, while for BAB, the manufacturing company has to be set up at 1/10/2000, after 1/10/2019. And see the difference in the tax rate. While under 115BA, it is 25%. Under BAB, it is as low as 15%. Of course, there are other conditions attached to it, but if you see BAA, you find that it is at a somewhere middle rate of 22%. Now, it doesn't stop there. You just look at the tax rate and it doesn't stop there. You see the next two rows. Tax rate on other income, including short-term capital gain on depreciable asset, it would be the same tax rate as is applicable for the normal, or 25%, 22 or 15. You look at the third column, tax rate on long-term capital gain would be as stipulated in the particular section. This is because all the three sections start with the non-obstante clause, saying that notwithstanding anything contained in the Act, and notwithstanding contained in, and once again, I'll just read it out. Notwithstanding anything contained in this Act, but subject to other provisions of this chapter. Now, all these comes under this other provisions, because the tax on capital gains under 111A or 112 comes under the same chapter. Hence, the long-term capital gain would come only at the rates prescribed under the respective section. So, if you have a corporate entity where you are finalizing, where it has got a short-term capital gain, it has got a business income, and it has got a long-term capital gain, even if you want to go under these sections, you may have to do two computations, one for the long-term capital gains and one for the other end. And look at the surcharge now. Under 115BA, it is a staggered surcharge of income up to 1 crore, no surcharge. 1 crore to 10 crores is 7%, and beyond 10 crores is 12%. while under the other two sections, it is at 10% flat, with the meaning that even if your income is 1 rupee, you may have to pay at the rate of 10%. And the cess is also applicable. Now you start comparing the net rate. Net rates, especially between 115 BA and BAA, if you look at it today, or even between the companies which goes on a turnover basis, which we discussed earlier, with 115 BAA, you would find you need to see whether there is effectively any big relief that is granted, because under the normal rate of 25%, 25% are based on the turnover. Your liability to surcharge will come only when the income exceeds a particular limit. Whereas if you go for the 22% rate of tax, there is a straight surcharge of 10%, which means effectively the rate becomes 24% immediately, 24.2% with the surcharge or with the cess also, where how far it is, whether it is worthwhile to go under the new, whether to exercise the option under the new section is the biggest challenge which the chartered accountant will have to do, or the tax auditor will have to advise. Now, even for this option also, as I said earlier, for these three sections, you find for the second one only, there is actually an option. For the first and the third, you have to necessarily exercise the option in the very first year itself of filing of the return. And so in the first year itself, even if the company is making a loss or may not have enough profits, if you want to go under the new sections or under the lower rate of tax, you will have to decide on whether to exercise the option. And of course, every corporate will only turn to the chartered accountant to advise him whether to exercise the option or not. Whereas under 115 BAA, which is for the lower rate, the CBDT has already clarified again by means of a circular that if you are having carryover losses or MAT credit, etc., you can defer the exercise of option to a later year, and it need not be done in the first year itself. So one may have to look into the various options that are available, various tax implications that are available, and also the next row of restrictions and deductions which you are going to forego before you can actually decide on. Now, for going under all the three sections, there are a lot of restrictions on the deductions as well as exemptions. Or most of the deductions, which we will another slide we'll be going through, most of the investment-based deductions are not available. Most of the income-based deductions are not available. And as a result of which, you may finally maybe paying tax basically on the book profit, except certain items like 43B, etc. And if you look at the next item, like the under 115 BA, if you see that even though it is on a lower rate, still the MAT is applicable, while for the other two options, the MAT is not applicable at all. In the cases where the MAT is applicable, you can the MAT credit under 115 JAA also is allowed, and MAT credit will not lapse. Whereas in the second category, you will find that MAT is not applicable. Naturally, as a corollary, the MAT credit brought forward also is not available, and the credit also will lapse. So if at all you have some taxes paid and lying in your debit balance or carrying it forward as a MAT credit, that also will lapse. Now, having exercised the option, can you get out of it? Yes, under 115 BA, you can exercise the option if you are going into 115 BAA, nothing else. You can only move from 115 BA to BAA. Otherwise, you have to continue with it, while no such option is available under the other two options. It is like the Bhagavad Gita Padma Vyuham. You can only enter, you cannot exit. Now, let us look at what are all the deductions. See, even though we say many of the deductions and exemptions are not available, there are also some sections, some deductions which are available also. So that is why I thought of putting up the slides which are all not available, and I have also put up the slides which are available. As I said earlier, most of these are deductions based. The first and foremost would be the 10AA for SEZ unit also. You are not getting any extra benefit. If you opt under the scheme, then you will have to pay the tax rate that is applicable to normal companies which are outside the SEZ also. And as far as the depreciation is concerned, the only place where the department has made a, or the as amendment has made a, this one is regarding the additional depreciation. The additional depreciation which is available for the additions to plant and machinery at an extra rate for manufacturing companies would not be available if you opt under any of these schemes. And the section also makes it clear that if it has been claimed for the earlier year and there is a carry forward loss on account of this claiming this additional depreciation, that also will not be allowed. So additional depreciation is one where you may have to recalculate even your WDV or the carry forward loss before you can decide on the exercising of this option. The rest of this are mostly the deductions which came at least 3-4 years before. If you look at most of these sections, which came about 4 years before, when the government came and said, when there was a big clamor by the industry saying that you are giving all the deductions based on the income that is generated, and in many cases industrial establishments are high capital intensive one, where they may not be able to get the profits in the first 5 years or 10 years, which is a time limit stipulated for most of these income based deductions. So the government said, okay, we are not going for the income based, we will give you deductions based on the investments based. That is how all these sections like 32AC, where investment in new plant and machinery, 32AD in notified backward areas, 33AB T-rubber development account, 33AB a site restoration fund, 35 expenditure on scientific research, 35AC expenditure on eligible projects and schemes were all investment based. Now, if you are going for the option under the scheme, you can forget about these sections, or rather, somebody was telling in a lighter way, if you are going for the lower rate of tax, you may not need a chartered accountant because you don't have to claim any of these exemptions. Again, it continues. 35AD expenditure on specified business. You see section 35AD. I think it has got about 8 to 9 subsections, various specified businesses. None of these businesses, if you go for the option, you will not get it. Agriculture extension projects, skill development project, nothing you will get. Then comes the most important one, chapter 6A. And if you look at there very closely, you will find the entire chapter 6A is not coming under it. It says under heading C. Even though we are all been using this Income Tax Act all these years, I don't think many of us would have been very familiar with the chapters or the headings under the chapters or even the subheadings. Now you need to be familiar with the headings and subheadings, because this they say under chapter 6A under heading C, which is relatively which covers the section 80 HH to 80 RRB, and there again they have carved out an exemption that 80 JJA, which is on number of employees, that exemption or that deduction would be available. So is it enough for you? Enough confusions have been created. So under C, 80 HH to 88 RRB, and with the exception of section 80 JJA. And it is when we start explaining these type of provisions, as a speaker, we normally miss seeing the participants, because I am looking at the blank screen and talking, and I do not know what is the reaction of most of the participants. And this is where we really miss it. And then that is something which we are also getting used to in the webinars. Again, as I said earlier, set off and carry forward losses of earlier years relatable to any of the items above. Not only 3218 additional depreciation, if the carry forward loss is on account of any of these deductions, then that also is not available. And as a last item, if you look at under 115 BAB, there are other conditions also to be specified, which I'm not going into because this is not a session on 115 BAB, because that itself would require another 1 hour to explain what are the conditions. But if you are going for an option, you please understand that certain other conditions have also to be satisfied. Now, that takes us to the eligible deductions. Now, as I said earlier, even though so many items they have said you are not, and generally it has been said that you are not entitled for any deductions. Surprisingly, I find that there are 3 deductions which are available. One, of course, ADJJA, it has been specified in the section itself. And this is where I said the heading of the chapter becomes important, because they have used the heading heading C under chapter 6A, and there are 2 deductions which come under chapter B, which is 80G donation and GGB contribution by companies to political parties or electoral trust. And that also is only applicable only for 2020-21, because by the Finance Act 2020, that deduction has also been clubbed, because they have for that words, use the words chapter 6A after heading, they have changed it now chapter 6A other than section 80JJA and 80M. 80M has been specifically brought in because the dividends becomes taxable from the current year 21-22 onwards. So for 2021, you would find that so many exemptions are not available, deductions are not available, so many exemptions are available. And especially I would welcome the even for 2021, 80G could be a very, very important one, because especially Kerala, there have been a lot of corporates who have contributed to the various funds, or even themselves to the donations, etc., to charitable activity. So naturally, getting the deduction under section 80G is a very, very welcome one for 2021. But please note that it is not available for 21-22. Now, for all other companies, existing rate of 30% with all eligible deductions and exemptions. Surcharge of 7% if income is between 1 crore and 10 crore, and above 10 crore means 12%, and eligible MAT credit and carry forward loss, including those related to exemptions. Now, what is the challenge here? Whether and when to exercise the option. As under 115BA, clarification has been given by CBDT saying that you can exercise the option anytime. But while exercising the option under 115BAA, you need to definitely see the tax impact on the exemptions or the deductions that are being foregone, the exemptions or the losses that are going to come on account of carry forward losses, the exemptions or the MAT credit which you would have already paid and taken and kept it as a debit item in the balance sheet, saying that you could get credit under 115JAA, that also will have to be foregone. So you may have to take an impact of all this and then find out whether you still have got a tax benefit by opting for the lower rate of tax. And the next one is very, very important. This is where I said, even for a company audit, you may have to decide on whether you are going for the lower rate of tax, even at the time of conclusion of the balance sheet itself, because on all the items on which you have calculated DTA for the earlier years, you would have calculated at the normal rate of tax of 30% plus surcharge and cess. Whereas if you are going for this option of this 115BAA or any of this, you will have to recalculate the DTA under the new rate of tax, because that will be the rate of tax at which the reversal will take place. So naturally, the excess amount that is lying in DTA will have to be reversed. And we had some interesting situations where a company which was a loss-making company, where they wanted to have exercise the option, and we found that when we reversed the excess credit on the DTAA, we found the company was coming into a profit. That is after reversal of the DTAA. So it was coming to a very, very peculiar situation of a company having an operating loss but ending up with a profit at the end of the year because of the reversal of DTA. So these type of peculiar situations will come, and you will find that if you look into individual cases, you will find very many options are coming up, and each day is an interesting day for me here and my partners here, because we get to come up with various options here, because every company audit is a case in point for discussion. So as I said earlier, the decision has to be taken based on the facts and circumstances of each case, and that poses the biggest challenge for the chartered accountant, and that is a necessity why I said we need to have the tax audit done at an early date and the return also finalized at an early date. I think in the last 35 or 40 years of my practice, this is the only time I would have probably discussed a 45 to 50 minutes on the rate of tax, especially for corporates. And that is in other words, that is the simplification or what we have done over the period of time. Now, if you are opting for BAA or BAB, there is a notification which has been issued saying that companies exercising option under 115 BAA are required to file Form 10 IC. That is a form to be filed, and that has to be filed electronically under DSC before the time limit under 139(1). Again, for BAB, it is another form called 10 ID. So you have never a dull moment. We have all the alphabets, just like the car numbers going from A to Z and then AA to ZZ. Now we have the income tax forms also getting into this alphabets. Now we have 10 IC and 10 ID. As long as they don't add another U to it, I am happy. Now let us look at the next, this one. Now we look into the amendments which have come in February 2019 Finance Act, which has a bearing on the tax audit. Now, if you look at the amendments also, one can understand if an amendment is simple, but you look at the amendment which has been made to Section 43B by including the NBFC. We are all familiar with Sections A to F over the years. And we have also seen that initially the interest on loans taken from banks and financial institutions were brought in. Initially, it was only for the term loans. Then they brought in for the cash credit. And now they are brought in for NBFC also. And NBFC, when they are brought in as a new section called Section DA. And it is not that every NBFC is covered. There also, they expect you to go and read the RBI provisions of what are all the categories of NBFC. Only two categories of NBFCs have been included. That is loan or borrowing from a deposit taking NBFC, or loan or borrowing from a systemically important non-deposit taking NBFC. Now, both these NBFCs are totally different. Conditions are different. As you would see from the explanation, deposit taking NBFC means NBFC accepting, holding public deposits and is registered with RBI. And NBFC means an NBFC as defined under Section 45IF of the RBI Act 1934. So now, before you want to apply 43B, first get a copy of the RBI Act, find out whether you are the NBFC which is reflecting in the balance sheet falls under 45IF, and then find out whether it falls under any of the two categories above. And you look at the last category, systemically important non-deposit taking NBFC means NBFC not accepting or holding public deposits and having total assets of not less than 500 crore as per last audited balance sheet and is registered with RBI. Imagine you not only necessarily have to see the client's balance sheet, you now have to find out whether this is a systemically important non-deposit taking NBFC. You need to go behind the NBFC now, and how we are going about doing it is something we need to see. How that is probably the one big change which have come in. which have come in for this year, and invariably we would have added with the pandemic. You would find that definitely for the month of March, definitely it is outstanding. March interest would not have been paid, and many of them would have taken the moratorium. And when it goes to the moratorium, you will find it as a new due date. And thankfully, the moratorium date has not been extended. So one should feel that as the original circular, RBI circular came, whatever was due in the month of March, the new date would be the August. In which case, when you are finalizing, then whether it has been paid in the month of August, then probably the disallowance may not get attracted. Or if it is paid before the time under 139(1), it may or may not get attracted. So you have all these dates to be kept in mind before you can decide on a simple section of a disallowance under section 43B. And they have added one more. Probably, I don't know whether they had a premonition in February 2019 when they brought in this amendment itself. They have added an explanation. Conversion of interest payable into new loan or borrowing will not be considered as payment. So, consequent to the pandemic, if any of these interests have been converted into demand loans or working capital loans or term loans, it would not be construed as interest it would not be considered as payment. So even though you may get due dates for staggered dates for repayment of the interest, you may still get the disallowance attracted. Now, something people who have been in practice in probably 2006 and 7 would have undergone the pain of enhanced depreciation, because what was brought in there has been brought in now in a different manner. And that too has, as in those days, it has now again come in the form of a notification. Notification 69/2019, dated 29/2019, depreciation on motor car. Now, the difference between 2006-7 and the current one is that at that point of time, what they brought in was that the enhanced depreciation was available using it in the business of running them on hire, while the current one is only for those people which are not used in the business of running them on hire. This is a substantial change from this one. If you look at motor car, it says that what is acquired after 23/8/2019 and put to use before 1/4/2020, such cars not to be used in the business of running them on hire, you will get an enhanced rate of 30%. Otherwise, you will get only a lower rate of 15%. Now, these are the days when motor cars, a normal commercial vehicle, you can either call it as a commercial vehicle or you can convert that into a passenger vehicle. Now, whether it will go into a motor car or otherwise, it would be possibly the one which could be the point of dispute now. But if you look at the word, they have just said motor car, and motor car not being defined under the income tax rules, one has to take the view that if you buy a commercial vehicle after this 23/8/2019 and use it for your own business, you may not be eligible for the enhanced depreciation, because these days, if you see, many of the people buy SUVs or even the bigger vehicles like Innova or Cresta, etc., which could either be used for commercial use or it be used as a passenger one. Now, how we are going to use it, and whether this would give rise to new questions of law or new disputes is something which we need to see. But right now, let us go by the strict interpretation and say if it falls under motor car, then, and if it is falling within these two dates, then of course you get the enhanced rate. Then for motor buses, lorries and taxis, here they have used the word used in a business of running them on hire. If it is used in a business of running them on hire, you would get an enhanced rate of 45%. And if it is not so, you will get a lower rate of 30%. Now, the advantage here that we have now is that we have some of the decided case laws under the old regime if it was against the SSC those days, it can be used in favor of the SSC now, because it explains what it means is as called the meaning of what it means on the running them on hire. If you take the case of CIT versus Gupta Global XM, which is a Supreme Court decision, which was followed by a decision in Kerala, where said motor vehicles which were predominantly used in own business, but higher charges received on occasional use by others would not fall under business of running them on hire, and hence not entitled for hire depreciation. The case in those days was that people used to buy vehicles and used it for own business, but before the year end, you would raise an invoice. Those days it was under VAT regime, not under GST regime, so there was no GST or VAT and service tax also at that point of time. So you could raise a invoice on your sister concern, make a nominal charges for higher charges of having hired it for one day or a few hours, and then claim the higher rate of depreciation of using them on hire. So the matter went right up to Supreme Court, and Supreme Court said if it has to be used on hire, these sort of where you are predominantly using it is for your own business, or unless you satisfy the condition of using them on hire, like especially if it is a motor taxi, etc., you may have to have it registered as a public carrier or things like that. Unless you do that, you will not be eligible. At that point of time, decision was against SSC, but this could be used now in favor of the SSC, because if the department turns around and says, if I have collected some higher charges for my sister concern, they cannot turn around now and say that you are using it on the business of running it on hire, because there is a decision in our favor saying that these are the conditions under which it can be construed as business of running them on hire. Then the other question in those days was that, you have the cases of the motor buses which are used as line buses, what we call it as the private buses as we call it here, or take the case of businesses, lorries or vehicles which were used in the business of transportation of goods, who are in the logistic business, whether they would be used in the business of running them on hire. That is fortunately there we have a Kerala High Court decision which says motor buses used in the business of transportation of goods or passengers is eligible for enhanced depreciation. And the explanation given is that whether the payment was made by one person or a group of person or by an individual passenger would be of total irrelevance in the context. The transport activity was as regards flying of transport buses carrying passengers on different routes determined by the transport authorities. In this particular case, it was a passenger transport, but similar decisions are available for goods transport also. So in those cases, the court has held, not only Kerala High Court, there are several cases which have come in other high courts also, even Madras Tribunal. I have myself got decisions where they have said, if you are in the business of transportation of goods, it only means that several people are taking the vehicle on hire, and the consignment charges which you are collecting, it only represent higher charges, and thus you could claim the enhanced rate of depreciation. So these are two decisions which are definitely helpful to you, old decisions. And it is here that, I was reminded, when I was preparing this, I was reminded of our Central Council member, Honorable Mr. GB, when he was saying in one of the seminars recently, where he said, whenever you want to go for older matters, kindly the youngsters may kindly look into people who are grey-haired or who have turned bald over a period of time. They could give you some inputs. You can possibly treat this one among that, and you could use this as a useful input for coming to the conclusion. Now, this is nothing to do with the tax audit as such, but then this is a new section which has been introduced, TDS on cash withdrawal under 194(n). Again, the section has come in earlier Finance Act itself, but there is a notification which came in later. Now, the section says there is a 2% cash withdrawal exceeding rupees 1 crore in aggregate by the deduction has to be made by every banking company, cooperative society, or post office. So any business person having or income carrying on business, if he is withdrawing money from a current account of exceeding 1 crore, it attracted 2% TDS. Now, the reason why we have put it up here is the 2% TDS would, of course, get reflected in your Form 26AS, and invariably you would have to claim it as a deduction of the TDS. But more importantly, especially with the smaller clients, we need to be very sure that these cash withdrawals are appearing in the cash book, because you do not know, especially non-corporates, it could be that the partner or the proprietor would have drawn the money and you would have used it for his own purpose, or you would have taken it as a withdrawal. He may have missed out entering this in the cash book. So this is one added responsibility for us to see that, even though it may not have any tax impact, but it is necessary for us to see that the 26AS is linked in with the cash withdrawal, with the TDS withdrawals. And in many cases, the TDS returns have been updated only now on 31/7. And I believe my partners also say in many cases where the TDS have been updated, one could find revised TDS returns could be coming in, because many of them have gone and filed returns to keep up with the due date of 31/7. Now, what does the notification say? The notification says the credit for the tax deducted under 194N shall be given to the person from whose account the TDS was made. So it was very clear that it has to go that way. It cannot be done any other way. But they have done it by making inserting a sub rule 3A in rule 37BA. Now, as far as TDS credit is concerned, you will find that rule 37BA is now turning out to be a very, very important section over the period of time, because 37BA itself would take some time to explain. I'll just rush through it, because 37BA gives you various options. In the sense, if the income is offered in a particular year, but the credit appears in a different year in your 26AS, 37BA will give you the option to tax it in the year in which you are offering it. 37BA also gives the option that if the tax credit is made in in the name of one person, but the income is offered in the hands of a different person, then 37BA gives the option to claim it in the hands of the different person. Of course, some formalities some procedural matters to be complied with. Olden days, we used to have a lot of cases where the contracts used to be the contracts used to be given in the name of, because we had a pre-qualification, it would be given in the name of individual, and that individual would have gone into a partnership firm, and the partnership firm would have executed the contract, but all the TDS returns or the TDS certificates from the government would be coming in the name of the individual, and it will have to be claimed in the hands of the firm, because it is a firm which is reflecting the income from those contracts. So 37BA, rule 37BA becomes a very, very important rule when it comes to claiming of credit and possibly deciding on in whose hands the income has to be taxed. Now, as we said earlier, even if you are going for a lower rate of tax, you could claim the credit of the deduction under section 80JJA, and 80JJA you find that by notification dated 104/2019, the deduction under the audit report format has been changed. Fortunately, they have retained the same form number, Form 10DA. It has only been revised, but the older form is not there. But I'm very sure, because it has to be uploaded online, you would definitely get only the newer form. But don't get surprised if you see the newer form on the site. It is already amended, and it is a much better form, because there were people like us who were handling this 80JJA for the last 2-3 years. We have found there were a lot of confusions in the old audit report. Many of them have been addressed right now. So you will have to go for the new Form 10DA if you are claiming a deduction under section 80JJA. Now, is it not enough? You find that Rule 6DD has been amended by notification dated 8/2020. Now, earlier, Rule 6DD had a subsection 5, 6, and 7. I think it was Rule 5, 6, and 7, I think, where they had said, once again, just give me 1 second. Yeah, you had Rule DD 5 to 7, which had used the words use of electronic clearing system through bank account, credit card, debit card, etc. These were covered under Rule 6DD itself. Now the clauses 5 to 7 has been dropped from Rule 6DD and a new Rule 6ABBA. Those of you who are who love English music would remember ABBA. There was a big music troupe in my younger days, my college days, ABBA. Probably you can remember that. Rule 6 ABBA, newly inserted to prescribe what are all the electronic modes of funds transfer, namely credit card, debit card. These two have been borrowed from the earlier section, earlier Rule 6DD, and they have now added net banking, IMPS, UPI, RTGS, NEFT, and BEAM. And they have, and I was trying to find out whether they have prescribed this alternate methods of payment other than cash or bank, where all it has been prescribed. I was surprised to find that there are 12 sections under which they have prescribed other electronic modes of fund transfer. I've just made a note of it. Clause 13D of Clause 30 and Section 13(3)(a), receipt of income by a donation by a political party. 35 ADF, capital expenditure incurred on specified business. Subsection 3, 3A, 3A, 4 of Section 40A, that is 40A3 as generally low. There also this has been brought in. Then Section 43(1), where you are purchasing a fixed asset if you are incurring the payment otherwise than by cash, the depreciation could be disallowed. Then the subsection 43CA4, where transfer real estate which is held as a stock in trade, you could have it has to be done by other electronic modes. Then proviso to Section 44 AD under presumptive taxation, and under 50C1 where there is a deemed sale value. Then second proviso to clause 56(2)(10), where there is a transfer, a deemed transfer, where it has to be taxed as a where the transfer is less than the fair market value, where it will be deemed as income in your hands. And just a second, and it would be taxed as income. And lastly, our familiar Section 269 SS, ST, and T, where these loans and deposit. So if it is other than check or this one, you need to necessarily see under if you are claiming the exemption as an electronic modes of transfer, you need to necessarily see that you comply with Section 6 above. Also, otherwise you could get into a problem, right? Now, the reason why I said is because as we go to the case laws, you would find that a recent interesting case law has come about last week or last month, which prompted me to spend some time on this rule also. Now, having done that, they also tweaked Section DDJ, and DDJ has been omitted. And prior to omission, the said clause read as where the payment was required to be made on a day on which banks were closed, either on account of holiday or strike. Then, if you had made the cash payment, there was an exemption possible. There were cases where construction sites used to claim under Section 80 DDJ, saying that the diesel or other this ones had to be purchased on a Sunday, and the wage payments etc. had to be paid on a Sunday or a holiday, and the banks were not available, and hence the Rule 60 DJ were invoked. Now it is no longer possible to invoke Rule DDJ. Now, fortunately, this amendment has come in only by notification dated 29th of January. So probably for the current year, you could possibly try it up to 28th of January and then start applying it only from the 29th of January. As if you don't have enough work, you have an added work to find out if somebody is claiming under DDJ, then to find out on what day it has been paid. Now, that comes as far as those things are concerned. Now, there are some amendments which are not necessarily related to tax audit, but could have an impact on individuals who may be coming under tax audit. Because you could have income from house property even in the hands of individuals who are coming under tax or proprietary concerns. That is why I have taken some of these sections. One is that in the case of self-occupied property, earlier we had the restriction of only option of taking nil for self-occupied only for one house. Now that has been amended that you can take it for two houses instead of one. Unfortunately, because it is two houses, you can also claim the interest on housing loan also on two houses, but of course subject to a maximum of 2 lakhs, so which is the restriction placed by section 71 subsection 3A. So it will be rule 24B read with subsection 71 3A, because in the immediately preceding year you may have forgone the interest where a person had more than 2 self-occupied houses, and you may not, or may have taken the value as the normal rental and then offered for a tax. This could be changed this year and you could be claiming the interest. That is a welcome measure. Now, for long-term capital gains, where you are claiming deduction under section 54, there is a new proviso added. Please see the highlighted portion where capital gain on sale of residential house does not exceed 2 crore. It is not a sale value, it is a capital gain. So it is a sale value minus index cost of acquisition. It is a capital gain. If it does not exceed 2 crore, you can purchase or construct 2 residential houses subject to other conditions being satisfied. So it need not be one house, you can go for 2 houses. So if at all somebody was putting into 2 flats, etc., earlier we used to know, you used to argue that 2 congruent flats, whether it is 1 or 2. Now, even if then the amendment came single, earlier we used to argue singular includes plural. Then the amendment came a residential house. Now they have gone back to saying 2 residential houses, and this could possibly be made use of. Now, when you are calculating the capital gains, of course, the cost inflation index also may play a part. Now, the cost inflation always comes in the form of a notification. Now, for 2019-20, the cost inflation index is 289. Now, we had the section 87A where we had an enhanced rebate, where it was earlier the limit was calculated at the rate of 3.5 lakhs. Now that has been raised up to 5 lakhs. So the exemption enhanced rebate under 87A can now be claimed up to 12,500, which is the 100% of the rate of tax up to 5 lakhs of rupees. Earlier, it had been restricted to 2,500. So people who are preparing the individual returns may make use of this 87A also. Some limits have been enhanced in the case of interest other than securities, where the taxpayer is a bank, post office, or cooperative society. The old limit of 10,000 has been enhanced to 40,000, and the rent also has been enhanced from 1,80,000 to 2,40,000. Now you see this 194A will apply only if the enhanced rate will apply only for interest paid by bank, post office, or cooperative society. If it is paid by the individual money lender or etc., or if it is an unsecured loan between corporates or director, etc., it would still attract the old rate of 5,000 itself. The limit would be 5,000 and TDS could be attracted. It's only for the bank it has been brought down. Now, with this, we have come through the amendments as well as the notifications. Now, we will see some 3-4 interesting case laws which have come in recently, which definitely adds to helps us while carrying out the audits. The first one was under section 37. It is a Gujarat High Court recent decision 418 ATR. It says that insurance premium on purchase of new car. There were certain decisions saying that when you are purchasing a new car, the insurance comes as cost of the capital expenditure because it is purchased along with the car itself. Because in many cases, the insurance premium was also included in the invoice, and hence they have said that it is part of the cost of the asset. Now there is fortunately a Gujarat High Court decision which says AO treating insurance premium on purchase of new car as capital expenditure for acquisition of asset. Insurance premium paid towards purchase of new car was revenue in nature and should be allowed in the year in which it was incurred. The object behind incurring insurance premium is to protect the vehicle from third-party thefts, damages, and such expenditure has to be incurred every year. Under the provisions of 31(2), insurance premium paid against the risk or damage or destruction, plant and machinery furniture is allowable, and this includes car also. Even earlier days, we had tribunal decisions which said insurance premium is required, or there were even cases where the registration fee paid for the road transport authority was treated as capital. There also we had decisions which said the registration with the road transport authorities is not for the purchase of the asset, it's for enabling the asset to be used on public road. Same way, insurance premium, unless you have a comprehensive insurance premium or third-party insurance premium, you cannot take out the vehicle on a public road. It was not necessarily for the purchase of the asset, but it was for the use of the asset on the public road. So now you have the strength of a High Court decision also, so you can possibly claim if at all somebody makes a dispute. We had n number of High Court decisions where the club membership fee was allowed as a revenue expenditure in the hands of the corporates. But unfortunately, Kerala did not have a decision, or in fact had a older decision in the case of OEN connectors, where they said it is a personal benefit. But now, fortunately, we have a decision of Kerala High Court in 416 ITR, where it's in the case of Apollo Tyres, where they have said amount spent for acquiring membership in the club stood on a different footing from the amounts incurred for availing material supplied or services provided by the clubs. Amount paid to obtain membership club was deductible. Earlier, we had the decision of Sundaram Finance in Madras High Court, where they had exactly followed the same view. They have said if you have enjoyed the services of the club, probably that could be looked into whether it is necessary for the purpose of business or it is a personal use. But membership fee, corporate membership fee was always for the benefit of business, because it was mostly taken in the name of either the corporate itself or employees of the corporate who could be using it for the purpose of business, or even directors who could be using it for the business. So fortunately, now we have a Kerala High Court decision where the club membership fee is allowable as an expenditure under Section 37. As I said earlier, when we were 40A3, we have an interesting decision here of the Allahabad High Court coming out recently, which says deposit of cash directly in the bank account of the beneficiary supplier was not routed through any clearing house, nor was the money sent through any electronic mode, and therefore such a transaction would not be covered by Rule 6DD C5, and the benefit of provision could not be given to the assessee. When the funds are transferred through electronic clearing system, at least two banks or two branches of the same bank are involved. Only then money is transferred through electronic clearing system. Now, this particular case, you look at the facts of the case. It was a case where the money was paid by the assessee into the bank account of the supplier, and they claimed exemption under Rule 6DD5, saying that it was paid under the electronic mode of as it stood then, as the word stood then, and it is interpreting that the High Court has said it is not electronic, it is you have only gone and there is only one bank involved or one branch involved when you are remitting the cash into the account of a particular person. Under that circumstances, the disallowance under 40A3 is upheld. Now, if you go into the later decisions now, we are having several decisions of the tribunal as well as of the High Court, where they have now started taking a view that if there are genuine expenses, even if incurred in cash, it should not be disallowed under 40A3. So all is not lost. Only thing is you need to look into these particular case laws and find out what are the circumstances under which the High Courts have come to this conclusion. Don't go by the head note that every genuine expense will not be disallowed. There could be some decisions otherwise also. I don't know. There could be some Kerala decisions also there. But you look at this under what circumstances it has been given. I remember two cases. One was a case of a real estate. I don't know whether it is this case law itself. One is a case of a real estate person where the land was purchased and the payment was made in cash, where the High Court of the Tribunal took the view that land is a registered document. The value that was paid in cash is available in the registered document with the sub-registrar office. So the genuineness could not be doubted. So the disallowance is not attractive. Second was a case where there was a government payment, KIST payment for the case of a liquor SSC, where they said the KIST was paid to the government or the government company for getting the license. So there also the genuineness cannot be questioned, and hence the disallowance is not attracted. So but don't go by the marginal note, go by the facts of this case before you can decide on whether you need to track the disallowance or not. And if you are relying on any of these case decisions, make sure that you make sufficient disclosure in the tax audit. What I'm trying to say is that 40A3 all is not lost even now. There are some if I may use the regular press language that is used or the government language that is used, we are seeing green shoots here and there. Now, this is a very interesting case law. I don't know how many of you have seen this. This is a very recent case law which came in and said, we are all paying educational cess and higher educational cess. And invariably, we always tend to treat it as a part of tax under section 40A2. Here it says it is not a tax and it can be claimed as an expenditure while computing your business income. Look at this. It's under the 1961 Act, the expression cess is quite conspicuous by its absence. The High Court has gone further to analyze and say that in fact legislative history bears out that this expression was in fact found to be found in the Income Tax Bill 1961, which was introduced in the Parliament. However, the Select Committee recommended the omission of expression cess, and consequently, this expression finds no place in the final text of the provision in 48 of the Act. The effect of such omission is that the provision in section 48(2) does not include cess, and consequently, cess, whenever paid in relation to business, is allowable as deductible expenditure. And it also cites a 1967 circular. I have not gone through the circular. In fact, there was a unreported decision which came in 2018 itself. Now, this is a very path-breaking one. Now, anyway, and it could be short-lived also, because the High Court itself has given a lot of clue as to how they have come to the conclusion. But possibly, going by the current way the regime, income tax regime is happening, you may not have a retrospective amendment. So possibly, you try and get it today for all corporates, because especially in the case of large corporate, cess can be a very big figure. We have taken this. We have been claiming it since last year, since this triple fertilizers decision, and we have not had any cases because these scrutiny are yet to come in. So we need to necessarily try this out, and we have found that substantial figures, a substantial impact is there on the profits and gains if you are applying this one. And now you are now equipped with another High Court decision. So there are two High Court decisions, and jurisdictional jurisprudence says that even if there is no jurisdictional High Court decision, if there are other High Court decisions, then the department is bound to follow. So this could be one which could be of big use. And at this rate of pandemic, when people are hurrying or scurrying here and there to find money to pay, and if there is a case where 140 has to be paid, this could probably come in handy. This is another interesting case where those who are in the share trading, where they have said, or even many of the corporates are do share trading, they have said, if you are holding some shares as stock in trade, and if there is a bonus issue on that stock, whether that will also be part of stock in trade, High Court says no. There is no presumption that bonus shares issued and shares held as stock in trade should also partake the character of stock in trade. Supreme Court in 73 ITR 652 held that bonus shares should be deemed to be distributed as capital and shareholder receives this as capital. Tribunal justified in treating bonus shares as investment. So if at all you have any share trading case, share trader or broker cases where they are holding it and some bonus shares are coming, because last year there was some bonus shares issued during, especially because the tax, the dividends was becoming taxable. Many companies have gone in for issue of bonus shares last year. So if you had any cases like this and if those bonus shares were actually sold, then you could possibly try in this as an investment. There is an interesting case under Section 80G, which came in only 2 weeks or 2 months before. It has not yet been reported. Very relevant for the current context, because whether CSR expenditure could be claimed under Section 80G. This is a decision of the ITAT Bangalore in the case of Goldman Sachs Private Limited, where they said CSR expenses are required to be incurred by the Companies Act under Section 135 of the Companies Act, and deduction under Section 37 of the Act is not available from 1516 as per explanation 2 to Section 37(1). So the very clear, the tribunal is very clear, it is not allowable under Section 37(1), but company has made a claim for a deduction under CSR expenses under Section 80G of the Income Tax Act. AO rejected the claim and observed that it is not a donation and was not spent voluntarily for the eligibility of claim under Section 80G, where the officer gave a definition for donation itself, or gave a ramification that it has to be voluntary, but due to the legal obligation prescribed under 135, and hence it said it is not eligible. The tribunal has gone about saying that pursuing Section 80G, we are of the opinion clauses 3HK and 3HL of Section 80G2 specifically excludes contribution to Swachh Bharat Kosh and Clean Ganga Fund. When these two exemptions are provided under Section 80G of the Act, it can be inferred that the other contributions made under 135(5) of the Companies Act are also eligible for 80G, subject to the assessee satisfying the requisite conditions. As I said, now Kerala has been reeling under this flood for 2 consecutive years, and there are several cases where many corporates would have gone under the CSR expenditure. You may kindly look at this section, which is available. This particular decision is available on the net. If you go to ITAT online or itat.nic.org.in, you will get this full text of the decision itself. You will get it and find out whether, if you satisfy the condition, you can definitely claim Section 80G also. And especially, if you recall, as I said earlier, why I went to that section, that option section or the lower rate section, is because there this 80G is eligible only for this year. For next year, the section has been amended, you will not be eligible. So this could probably the only year, and even if an amendment is going to come, it is not going to have any impact. You can possibly claim it in the only year you can claim. Now, this is not strictly tax audit, but I put it across because this is a Supreme Court decision, because we come across many times when these are the days when many companies go into merger, demerger, amalgamations, etc., where we are not able to file a return or a revised return because the electronic portal does not allow. Because the question many a time asked is whether the portal overrides the provisions of the Income Tax Act, and all our friends who are in the income tax department just put their hand up and say, sorry sir, it is beyond us. But now the Supreme Court has come down very heavily and said, even though there have been other decisions on e-assessments, etc., this is a very, very powerful one, where it says, insofar as Rule 12(3) of the income tax rules, which requires filing of returns electronically, is concerned, an assessee cannot be rendered remediless just because the income tax website did not allow a window to the respective assessee for filing returns of income electronically, as revised returns of income for filed beyond the prescribed period as stipulated under 139(5). And they go on to say, in view of the fact that the assessee was entitled to file revised return in respect of schemes or arrangements and amalgamation, which are approved by NCLT or by the court, and IT department being given an opportunity did not raise any objection thereto within the stipulated period, under what 235 of the Companies Act, the scheme sanctioned by NCLT attains statutory force, and therefore the dominant department is directed to receive the revised return filed by the SSC beyond the due date. They have even used the word even physically, and they have said neither section 119(2)(b) or under 139(5) is applicable to the facts of the case. Because here I think they have used the section 119(2)(b), they went to the CBDT. CBDT also rejected it. That is when it has gone to the High Court, and finally the Supreme Court has said that revised returns, even if it is beyond time, website is or your e-filing portal is not the deciding authority if a revised return can otherwise be filed. This is a very, very welcome measure. Now, department will be bound to accept this. If it is not, you can definitely approach it, take it up in the court of law, and you can make the return to be accepted. Now, this is again another one where change of address, many a times change of address takes place, and the SSCs forget to change it in the PAN. Now, this is a case where this is issued in the context of issue of 143(2) notice. But here again, the Supreme Court has come, which is in favor of the department this time. They have said, mere mention by the SSC of his new address in the return of income without specifically intimating the assessing officer with respect to change of address and without getting the permanent account number database changed is not sufficient. In the absence of specific intimation to the assessing officer with respect to the change in address or change in name of the assessee, assessing officer would be justified in sending the notice at available address mentioned in the permanent account database, more particularly when the return has been filed under the e-module scheme, which would be sufficient compliance of the requirement. So wherever the SSC has made a change in address, they have not only used the word intimation of change in address, they have said changing of the database, permanent account number database. So one has to be very careful. This is a Supreme Court decision, very recent Supreme Court decision in 418 ITR 662, where if we are seeing, or when you are uploading the return, you find if the assessee's address gets automatically dropped down from the system, and if it is not the current address which the assessee is using, then please make sure that the PAN number database is changed to the correct address. I think with this we come to the case laws, and we'll now move into the last section. I think I have another 5-10 minutes. I think, Chairman, I have another 5-10 minutes.
Yes, sir.
Yeah. Now we'll go only some 3-4 cases of ICAI FIQ, where they said there are many cases where even when I have represented before the tribunal or before the Commissioner of Income Tax, where they have said whether we are required, whether our tax auditor is required to issue a tax audit report in the physical form, or whether he can just fill it up in the e-filing portal, probably take a printout of it and sign it, whether it would be enough. Now, the ICAI FAQ, even though it was rendered earlier, probably even before the e-filing forms, etc. came, they have said balance sheet, profit loss account in Word, Excel format, etc. signed as SD can be converted into PDF file and uploaded on the portal. However, auditor should maintain the physically signed audit report in his records and ensure that there is no difference between physical report and the PDF uploaded. And if you look at today the guidance note, you will find invariably in many cases the PDF has got very limited options, or if you are filling up the 3CD form in this assessing, it has got very limited options. There are many cases where you have to say either yes or no, and where the guidance note says you can either fill up yes or no, but supplemented by a physical certificate supporting your view why you have selected yes or no. So I would still go by the Institute FAQ, where I would recommend that the physical form should be printed out in every case, And there are even cases where the SSEs, some chartered accountants get the Form 3 CD signed by the SSEs also, because it is essentially, it has to be prepared by the SSEs also, and such document is kept as part of the audit document. Now, where should comments observations in respect of a particular clause in Form 3 CPE is to be mentioned in E-form. This is what I said earlier. Comments observations, if any, relating to clauses may be given in 3CA, 3CB, subject to space provided therein. Alternatively, they can be uploaded as a PDF file in the field, upload other report of the portal. Okay, that is the cases where if you are particularly relying on certain particular case law or particular view which you have taken, you could possibly have this FAQ by the institute following how you should be complying with the tax audit. This is again an older one. In case of tax audit report conducted by the joint auditors, what is the procedure? It says e-filing portal allows audit report to be uploaded by a single auditor only. Therefore, the joint auditors may mutually agree and decide upon the auditor who shall upload the report. Or all joint auditors should sign the hard copies. In other words, it means there has to be a physical audit report where all the joint auditors sign. And then it goes on to say that as per standards on auditing 299 issued by ICAI, the joint auditors are able to arrive at an agreed report. In such a case, the physical copy should be signed by all the auditors, and thereafter any one of them may upload the report, especially in the case of government companies or where you are a joint auditor. Kindly ensure that these documentations are well taken care of. Now, is it possible to file the ITR first and then file the audit report? Now, I think that becomes irrelevant today, because you have first file the audit report 1 month before and then only file the tax return. So, and we have had many cases up to the last year where they said the tax audit report has to be filed, or the tax audit report or the charitable institutions audit report has to be filed along with the return. And we have had many cases where notices were issued where the tax audit report was uploaded or the audit report was uploaded after filing of the return. The CPC or the computer took the view that this is not filed along with the return, and exemptions were denied. Now, that again had went through some very rigorous process, and finally CBDT came out with a circular saying that within a time limit, if you upload these returns again, audit reports again, it could be treated as sufficient compliance. But I'm told that many cases the auditors were careful enough to file the audit report at the beginning itself and then file the tax audit reports. I think that comes to the end of my presentation. I think I now hand it over back to the chairman.
There are certain questions, I think.
Let me just come back to, because I'm not very tech savvy person. Let me get back to this.
Joseph will read it if it is needed. Joseph will read it.
Sir, good evening. Oh, Vasant, how are you? Good evening. Subramaniam Iyer, good evening. There is a reference about 26A, special transactions of payment from bank for an amount 10 lakhs. Can answer be given in the file or should be given separate? There is a reference in 26A about special transaction of payment from bank for an amount of 10 lakhs. Can answer be given filing the tax return? Now, if the tax return permits you to do it, you will have to do it. But many of these special transactions which are coming in the SFT, we find that there are a lot of errors have come in the SFT which have been uploaded. Recently, we had a case in the case of a company where the cash was withdrawn from the current account of the company, more than 1 crore or so, but it unfortunately got uploaded in the finance manager's PAN number, and it got reflected in his 26As. So there could be cases which could be coming. So we need to look at these cases, whether these are genuine transactions. And even if it is, if you are getting a notice under the e-campaign model, which has started recently, we have got a clarification from CBDT saying that where you are not agreeing to it, or if it is totally wrong, like the one which I have explained, you can file a reply that it is either incorrect or denied. These are early days, and the CBDT clarification goes on to explain. This is, of course, a private one, not given to me, but to one of the commissioners, where they said if it is denied or mentioned as incorrect, the department would go back to the person who has filed the SFT returns and then find out, then come back to the SSC again with the corrected version. This is again on the 26 days only. Are there any other questions, Jos?
Yes, sir. In Q&A, one question from Rubesh.
Where do I go? Oh, 1 minute. Where do I go?
The next to chat, there is 3 dots. We can see 3 dots next to chat.
Next to chat.
On the reporting requirements in 3CD, especially in clause 41, if any, either in this assessment year or coming assessment year, if there is any variation in turnover in amnesty, how far it will affect income tax liability?
Now, see, the question is, if you are going for a settlement scheme where you are accepting a higher turnover and settling it for VAT under the amnesty scheme, and you are accepting that higher turnover, there is always a possibility of that being shared with income tax department, because we find that in many search cases where higher turnover is accepted in the income tax searches, they immediately end up transferring this data to the GST department or GST or the VAT department also. So there is a possibility. So it may not come under 41.1. 41.1 is what you call cessation of liability. But if it is a suppression of turnover, possibly you will have to consider it. But one must also keep it in mind, while for the VAT purposes, the turnover would mean the taxes based on the turnover. Whereas for the income tax, the tax is only on the net income earned and not on the gross turnover, additional turnover, which you have disclosed to the VAT department. So this may kindly be borne in mind. So if at all you have had to have a additional disclosure to be made, you need to find out whether on account of having this additional turnover, whether there was an additional purchase also which was not considered, and if there is a net income only need to be offered for taxes.
Okay, sir. Next question, sir. Honorable Supreme Court, the case of
I have now found the
you got it. Okay.
3 dots. Where is it?
Q&A. You can see the Q&A. 3 dots. If you click on 3 dots on the top, you can see Q&A.
Yeah. I say okay. Now here is this one by Mr. Rupesh.
Yeah, Rupesh. Yes.
No, I'm not able to see it. I think you better read it. That's good.
Yeah. Next one is Honorable Supreme Court in the case of Rajasthan State Beverage Corporation Limited has dismissed the SLP on the revenue. What is the legal position now of disallowance of employee contribution under section 36(1)(5)(a) and reported under clause 20(b)?
Yeah. See, the question is, this is one as far as SLP dismissal is concerned. Now the law is very clear, or at least the legal fraternity is very clear as far as SLP is concerned. Now, if an SLP is dismissed, then it only means that the further appeal to the Supreme Court by against the High Court decision is dismissed. It does not lay down a position of law. But if the SLP is dismissed as devoid of merits, or after considering the merits, even if it is only one line in the Supreme Court order saying that SLP dismissed as devoid of merits or as on merits dismissed, then it lays down the position of law. As far as Rajasthan State Beverages Corporation is concerned, it is dismissed as devoid of merits, but unfortunately, the tribunals and High Court, many of the High Courts have not been accepting this. In fact, we have 2 cases from the Kerala High Court. One, our own case in the case of Popular Vehicles and Services, where we have approached the Supreme Court, and the other was in the case of Mercom Limited, who have joined after we have filed the Supreme Court case in the case of Popular Vehicles and Services, where the department, Justice UU Lilith, was in favor of allowing the appeal, when department turned around and said all the cases where the high courts have taken other decisions have to be taken together. And as the law stands today, the department has filed a petition before the Supreme Court, and Supreme Court has said this, that employee contribution of 3615A would be taken up together and disposed of. And it would have been taken up in the month of February or March, but unfortunately, because of the pandemic, now it has gone into the shelves. You don't know when it is going to come. So it is, you may not, especially in Kerala, you may not be able to succeed by stating Rajasthan State Level Registrar.
Sir, could you elaborate on a residential house for long-term capital gain under section 54?
No, yeah, that was earlier under section 54. Whether you could invest in more than one residential house was clarified. But now, now 1 second, let me just take out section 54, where if you have invested in a residential house is the word used in 54. 1 second. To one residential house. It was earlier constructed a residential house. When we said A means does not mean one singular includes plural, then they amended it by bringing in one residential house. That also has undergone an amendment now, where the capital gain is less than 2 crores, you can claim for 2 houses. That is the amendment.
Okay, thank you, sir. Now, whether surcharge is an allowable expenditure?
Look at section 48(2). Surcharge is part of tax. That is why they have used the word cess. Let us look at 48(2). I think 48(2) talks about surcharge also. Any sum paid on account of tax levies of profits of reserve motion on the basis of any such expenditure, it is I think somewhere they have said surcharge is also part of tax. Let me just come back to you. Definitely surcharge is also is part of it. That is why they have taken the word cess.
Okay. Sir, accounting professionals not offering 50% of their turnover, gross receipts, as income from profession, are they liable for audit under section 44AB, even if the turnover is less than 10 lakhs?
You are talking about 40 ADA?
44 ADA, yeah. Yes.
If you are going under 44 ADA, it is under presumptive rate. And the question is, if you are below that rate and if you are going for the presumptive rate, then you will not go for the audit.
So whether audit is, the income.
If you are not willing to take, if you are not going to take less than 50%, then you, I think 44 ADA permits you to go for a, you don't exercise the option, you go under the regular one. 44 ADA is only an optional one. It is not, you should mandatorily go for that.
Yes, so
because 44 ADA 5 gives you the provision. Notwithstanding anything in contained and foregoing provisions, it says maximum. There is 141, you can get it audited in file of return.
Yes. Sir, we are facing issue due to 143(1) adjustment in case of a delayed remittance of employee contribution to P.F.Veeramani. Is there any resolution to this issue?
So right now there is no resolution, but we have found in many cases the this is being applied as a prima facie adjustment based on the tax audit report itself, which we have been objecting, but unfortunately it has been falling on deaf ears. Somebody may have to go to the court and get a decision saying that the matter is before the Supreme Court and hence cannot be a prima facie adjustment. Okay, you can't expect any decision from the CIT appeals or the tribunal. You may have to go on a writ to the High Court and possibly get a decision.
Sir, if cess or CSR expenses are claimed by assessee, whether the tax auditor has to refer it in his tax audit report as a precaution.
Well, nothing wrong. If you are not convinced of this or ADG or whatever be the claim, nothing wrong. It is only an abundant caution. You can always make a mention of it, and it would be better if you mention and then rely on the case law also, which will help you also.
I think Rubesh Pai is asking, sir, in reporting under clause 41 of 3CD on Kerala VAT amnesty.
Oh, you are talking about 41 of 3CD. I took it
3CD. Yeah, 3CD. Yes, sir. So that I think that's the end of the questions in Q&A session.
Yes.
Any other questions?
I think I'm rather overwhelmed that we have about 138 participants.
Yes.
At such an early time for tax audits.
No, but it's an information, I think. So because we can, members can be prepared and they go for this audit. That is what we intended.
Okay. Maybe the next session which we are going to do on tax audit on clause by clause analysis, it will be more questions coming in based on what steps.
Anyway, I hope that there is no other question. Really, it was a very, very lucid and excellent presentation covering the rates, important amendments, changes, circulars, and finally the decided cases which are affecting our work in fact. So a great effort. I think always you are supporting the branch and members with your wise words and advices also. Once again, I'm placed on record your continuous support to the e-newsletter of ICAI Ernakulam branch without any fail, with so much dedication you are showing. So I don't know how to thank you personally.
I think the thanks should go to our KX Jose. He was the person who initiated it.
Oh,
and he was very clear. Others will not be able to drop it even in the newsletter as long as the newsletter comes out. I think the entire credit should go to KX Jose.
Not only you, but I think Vijay Jodi sir also contributing.
That's what I said. Yeah, that is why I said that the credit should go to VX Jose. Sorry, not KX.
Yes.
VX Jose, our former chairman as well as SIRC.
Anyway, no words. Thank you for your great effort today. It was nice of you. As you mentioned, for our bank audits also you were here, and again in this tax audit, this seminar also, webinar also, you were presenting. Personally, on behalf of not on behalf of branch, my personal thanks to you for your accepting our invitation and coming, presenting such a wonderful session here today. And I request Josh for a formal vote of thanks, please.
Thank you, Chairman. Thank you, Veeramani sir, for that wonderful session on this new changes and amendments in income tax law pertaining to 2019-20. Definitely, it will help all the participants here for the forthcoming tax audit season. That's why you can see around 180 participants were there. Almost 200 registration. Normally there will be some missing, after registration and attending the classes, seminars. Yeah, but around 180 participants were there. It was really a wonderful session within a short period of time, 2 hours. You could elaborate on almost all the changes and very easily, very wonderfully you have elaborated on that. Thank you very much on behalf of Ernakulam branch and all MC members and all the participants here. I extend a sincere gratitude to you, sir. Thank you very much. And I also thank the MC members here present, Vice Chairman Ranjit. Thank you very much. And I also thank all the participants for making this session a great one. Like 180 is I think one of the largest number participations in the recent past. So thank you all the participants.